Please start.
স্যার আপনি কি জেএমএ?
Hello.
হ্যাঁ, অ্যাকচুয়ালি স্যার আমি অপূর্ব হালদার।
Sir, please start.
আপনার নাম্বারটা আমি আমাদের সিনিয়র
আচ্ছা, ক্লাসটাতে শোনা যাচ্ছে কিনা একটু চেক করবেন। হ্যালো, লাইভ হয়ে গেছে তো? ওকে, ঠিক আছে, ঠিক আছে, ওকে। Am I audible?
ওয়াকিং যায়।
Yes,
Hello.
sir. Yes, sir. Yes, sir.
Hello.
Yes, sir.
Someone please reply. Am I audible? Hello.
হ্যালো,
ঠিক আছে, 20 জন থেকে 30 জনের।
শুনতে পাচ্ছি না? ঠিক আছে, এবার sir,
Am I audible?
আপনি কথা
yes, sir. Yes, sir.
Okay.
Hmm.
Then let me start the class. Okay. Thank you.
Okay, please start. Please start.
জানান স্যার।
Okay. Dear students, I welcome you all again on this yet another session on corporate financial accounting, paper number 18 under the new syllabus 2022. And we have already discussed a few topics in our previous 3 sessions, and I'm likely to continue that particular momentum again by taking up certain a few other issues which are important again from the viewpoint of the examination. Keeping in mind of the examination, we are actually picking up certain topic which will be important for the examination purpose, and in that way our today's topic will be valuation of goodwill and shares. And if with the given time frame we can complete the discussion on this particular topic, then I'm also expecting to start a new topic, value added statement, provided I can complete this discussion on valuation of share and goodwill within the given 2-hour time. So let me just share with you the notes first. This notes in form of a PPT will be shared with you later on. Now while discussing this valuation of corporate securities and business, obviously it is not chapter 2. The note has been prepared for another purpose, and keeping that in mind, the chapter 2 was there. This is a separate module that has been mentioned in the syllabus appropriately. Now, the valuation of corporate securities and business, when we talk about, then the very first thing that come to our mind, what is the purpose of this valuation? Now, obviously, the purpose of this valuation, if we want to know, then we need to discuss about, first of all, the concept of share and why that particular purpose it serves. Keeping that in mind, we will be in a position to explain why that valuation of shares will be required. Valuation of goodwill comes along with this valuation of share, and this entire topic, this valuation of share, valuation of goodwill, it comes under the broader purview of the topic valuation of corporate securities and business. Okay, so we are basically keeping in mind the syllabus of the institute, basically discussing the valuation of share part only and not the other areas. Now, if we go through the basic concept of shares, then we find that share represent the portion of capital contributed to a company. Whenever a company goes for incorporation, at that time the company is given an authorized capital. That is the maximum amount of capital the company can raise. Now, the company may issue certain instruments to procure this much amount of capital, and that particular instrument is known as share. So basically, share represents a portion of company's capital which is owned by a particular shareholder. Now, these shares may be of two types: equity shares, which we also call ordinary share. The term ordinary share is actually a Western term, in the sense that in India, basically we use the term equity shares for referring to the financial instrument we are talking about. Now, as I have already mentioned here, that shares are of two types. One is equity share, which is also known as ordinary share, and another is the preference share. Now, while equity share represents the ownership interest in a company and hence have voting rights, preference shares enjoy some preference over equity share in terms of the dividend payment as well as distribution in the event of liquidation. So basically, when we talk about equity share, they represent certain representation in companies' capital net assets, in the sense net assets. Accordingly, they are the real owner of any company. On the other hand, these preference shareholders, they are a category of shareholders who enjoy certain preference over the equity shareholders, and this preference is observed in two aspects. First of all, this preference shareholders, they are entitled to dividend prior to the equity shareholder. That is, before paying up dividend to the equity shareholder, we need to pay the preference shareholder their dividend. On the other hand, if the company is going into liquidation, at that time, the assets of the company, whatever assets realized, whatever amount is realized, first will be discussed before equity shareholder. It will first be distributed among the preference shareholders, and then only if anything is left, that will go to the equity shareholders. So in that way, they enjoy the preference over equity share in these two aspects. Now comes the concept of valuation of shares. Now, basically, when we talk about valuation, it is a process of determining the real worth of each and every share. Why it is so? Because a company grows over the time, and the share, say one particular share having a face value of 10 does not mean that its worth is 10. As the company grows, net asset of the company grows, this each 10 rupee share worth more than 10 rupee, sometimes some quite 100 or 1000 rupees in certain cases. So basically, each and every share is having a separate worth over the time, which is called its real worth or intrinsic value. Valuation is the process of determining that intrinsic value of each share, be it equity share or preference share. In a market-driven economy, which is a vibrant capital market where shares of all categories are generally listed, market value represents the value per share. So if, say, in the context of India, we are having BSE, NSE, these two leading stock exchanges, and if your company is being listed in a recognized stock exchange like BSE or NSE, it is fetching some amount of value, which we call the market price. If the market is perfect, if the market is vibrant, quite strong, then the market price is the true indicator of that intrinsic value we are talking about. So in that case, market price per share is theoretically equal to the intrinsic value per share. However, if the market is not perfect, if the capital market is imperfect, or if your shares are not listed, then the market value or market price either is not dependable, or even if it is available, it is not dependable, or it is not available as the shares are not listed. So in that case, separate exercise is required to determine that real or intrinsic worth of each share. As I have already mentioned, the process is called valuation of shares. And obviously for valuation here, we will mean valuation of equity as well as valuation of preference share, both. Now comes the question, why should we go for a valuation? Why should not we consider only the value available in the market, or why we are not concerned about only the face value? First of all, as I have already mentioned, over the time the company grows and face value does not indicate the real worth. So the valuation is required. And in case the company is being listed in a recognized stock exchange, which is not perfect, even if the market price is available, that is not dependable. So in these cases, for unlisted companies and where the market price is not dependable, valuation is required. But using this valuation or determining the value per share, what we will actually do? The need for valuation arises because of the following reasons. First of all, amalgamation, merger and acquisition. Say we are talking about two company, A Limited and B Limited, and A Limited wants to acquire the shares of B Limited. So in that case, the A Limited need to purchase the shares of B Limited through various routes, either through open market or some other process from the shareholders of the B Limited. And in this process, it needs to pay some amount to the B Limited. Now, the amount that A Limited needs to pay to the B Limited is known as purchase consideration. Now, what will be the purchase consideration payable by the A Limited to the B Limited? This depends on the worth of the shares, worth of the net assets of the company. And these net assets are represented by the shares. So net assets divided by the number of shares will give you the value for each and every share, and at that value the purchase consideration needs to be discharged. For example, the net asset, suppose the worth of the net assets of the company is 1 lakh and number of shares held by the shareholders of B Limited is 10,000. So in that case, per share value will come 10. In that way, by discharging the purchase consideration at the rate rupees 10 per share, the A Limited can purchase the shares from the shareholder of B Limited in an acquisition process. Similarly, in case of amalgamation or merger, also two companies merges into a new company, and in that case also determining this net worth. Determining this net worth is equally important because discharge of purchase consideration is based on this one only. Now comes the question, what are the other purposes in which this valuation will be required? Now, there obviously are other ways, other reasons for which valuation is required, and some of the other reasons I have mentioned here in detail. Now, the second reason that is most important for the purpose of that is conversion of preference shares or debentures into equity shares. Just a minute. Right. So conversion of preference share into or debentures into equity share. Now, sometimes the company issues certain convertible instruments, convertible preference share, convertible debenture. So in that case, after a certain point of time, after the specific point of time, the company needs to convert this either at the option of the holder or at the option of the company into equity share. Now, what will be the conversion ratio? That is dependent on the value of the equity share. Suppose the preference share face value is 100 and we want to exchange one preference share rupees 100 and the intrinsic value of equity share determined is rupees 25. So in that case, for each preference share, 4 equity share will be issued. Okay, similar is the case with debenture. So conversion of preference share or debenture into equity shares in these cases, determining the conversion ratio requires valuation of equity shares. Now, when the company issues new shares or issues shares under ESOP or ESPP or issue of when the company goes for an issue of sweat equity share, in that case also determining the issue price largely depends on this valuation purposes. Okay, for example, when the unlisted company is going to get share listed on the when a company is going to issue initial public offer, then also the determination of that price band that requires calculating the value per share. Again, if suppose a company wants to raise loan from any financial institution and it has certain investment in some other company, in say X Limited or Y Limited. So in that case also, by pledging the shares of X Limited and Y Limited, which are my investments, I can raise loan from the bank, and at that time how much amount of loan can bank issue depends on the worth of the share. So in that case also valuation may be required. Implementing a scheme of nationalization, when a company is getting nationalized by some government, again determining the purchase consideration requires the valuation of shares of the company. So these are some of the needs or some of the purposes for valuation. Now, whatever be the needs, we need to calculate the value per share by following certain well-defined methodology. And this methodology or methods of valuation is not there is no unanimous method as such. The different proponents, different perspective have raised various type of methods. Now, these methods that are available for valuation of shares can broadly be classified into these groups. There is asset-based valuation or asset backing approach. There is earning-based valuation or yield approach. There is dividend-based valuation, where one of the most popular model, dividend discounting model proposed by Gordon, is used to calculate the value per share. There is cash flow based approach, which is known as FCFA or free cash flow to firm or free cash flow to equity method of valuation. And finally, there is a new approach called relative valuation approach, largely used in security analysis. For example, earning multiple is one of the methods. Now, in accounting, depending upon the situation and information available, all the methods can be used, but most popular method and traditional method of share valuation in accounting are asset-based valuation or asset backing approach and earning-based valuation or earning or yield approach. Dividend yield also is another variant of yield approach which we use. But this dividend-based valuation, cash flow-based valuation, these are mostly used in business valuation, that particular module or that particular subject. And relative valuation we normally use in the security analysis paper, but they are equally applicable in any case. Okay. In actual practice, calculation of or determination of the value of share does not is not at all guided by any one method. Rather, the valuers may apply more than one method and get a average of the same to determine the value per share, not depending upon any particular method. Now, in this chapter, we shall mainly focus on asset backing and yield approaches. Other methods of valuation will be covered in papers, in certain papers like performance management and strategic performance management business valuation. Okay, those papers we can find the approaches, other approaches that we have already mentioned. Okay, next, asset backing approach. Let us start with the asset backing approach. So under asset backing approach, which is also known as intrinsic value method or net asset method, the value of a share is simply the net assets attributable to such share. Thus, under this method, the value of an equity share is simply the net assets available to the equity shareholders divided by the number of equity share. However, the value of assets and liabilities under consideration must be at the fair value. So when we under asset backing approach calculate the value per share, basically we need to get the fair value of assets, from where we need to deduct the fair value of outside liabilities to get the fair value of net assets. And this fair value of net asset is divided by the number of equity shares. That will give us the intrinsic value per share. That is a very basic methodology. Obviously, there are different type of adjustment, different type of situations available, and we will take up different situation one by one. Now, while making this asset backing value, one of the important point adjustment is in valuation of goodwill. Now, why it is so important? Because an organization successfully running its business builds goodwill over the years. It is not something for which the company is consciously making some contribution and creating the goodwill. This goodwill may be the result of its superior customer engagement, superior marketing production or distribution skills, which get translated into some competitive advantage for the company, and that results into its superior earning capability. So basically, this superior earning capabilities may be sustainable. When sustainable, at least for a number of future years, we call that goodwill. The value of this superior sustainable profitability is known as goodwill of the business. Unfortunately, the fair value of net assets over the outside liabilities may not represent the true worth of the company unless this value of goodwill, which is basically here we call the self-generated goodwill, is included as an asset. However, this value must not be accounted for in the conventional accounting process. Only purchase goodwill should be accounted for. Let us have an example of an online aggregating service, online aggregator company. Suppose the online aggregator is, say, take the example of Policy Bazaar. It is an online insurance aggregator. Now, since it is an online insurance aggregator, basically its function is to compare the quotes available in different insurance websites and accordingly guide you to select your appropriate choice of the policy. So in that way, it does not need huge amount of infrastructure to be in place to perform its services. Rather, the services are being controlled by a few employees and the software itself. Accordingly, if any company is going to buy Policy Bazaar, then when it will calculate the fair value of its net assets, the assets that it's actually owning in as per its balance sheet, obviously the value will be only a few lakhs or few crores, while the real worth lies in the fact that how they integrate the different service providers, the different insurance providers, and how they connect with the customer. So their value lies with some intangible aspects of the company's operations, its engagement with the customers, way of servicing, which are not at all reflecting in the assets that the company is owning. Accordingly, the fair value of net assets and its worth, company's worth, will be completely different. And the difference is actually the intangible factors combined together into goodwill. Similarly, since this goodwill in our normal balance sheet that we prepare and report on a regular basis to the regulators, that do not reflect this value of goodwill, and never can you record also this value of goodwill, which is your self-generated. Self-generated goodwill can never be recorded because that will lead to inflation of profit and capital erosion over the time. But when, say, a company is purchasing Policy Bazaar, that company at the time of paying the purchase consideration, suppose the net asset of Policy Bazaar is 1 lakh and it is the company is paying rupees 2 lakh. So additional 1 lakh it will record as the goodwill. That goodwill is a purchased goodwill. So goodwill which we value for a company is the self-generated goodwill, and that goodwill the company will not record in its books of accounts. That is only for valuation purpose, and that valuation will help the company to determine its real worth and accordingly to negotiate for the purchase consideration accordingly. Only the company which is purchasing the other company and paying purchase consideration more than the net assets of the company will recognize the difference as purchase goodwill and record that goodwill accordingly. Over the time it will amortize also. Nevertheless, due to immense importance, valuation of goodwill requires detailed discussion, because unless valuation of goodwill is done separately, you cannot go for valuation of share. So first of all, we need to determine the valuation of goodwill. Now, the value of goodwill is the value of company's superior earning capacity, as I have already mentioned. Now, this superior earning capacity we therefore need to calculate. And there are two approaches for this. One is average profit method, another is super profit method. However, not all the variants of average profit methods are equally justified to calculate the goodwill as the super earning or superior earning capability. Super profit approach is the most desirable approach. Still, we will discuss both of them. Now, average profit method. Now, as the name suggests, under this method, average profits are calculated as average maintainable trading profit as follows. Now, why it is trading profit, why it is maintainable, and why it is average, we need to explain. First of all, a company generates goodwill due to its operating activities. That is, company having some surplus amount of fund, investing it elsewhere and earning some return. This does not generate goodwill. Goodwill is generated by your regular connection with the customer, by your superior distribution network, etc. So goodwill is generated only due to operating activities, operating or trading activities. So only trading profit we will consider, not the net profit, which may include certain non-trading income or non-trading expenditure. So we need to adjust for non-trading income and expenditure to the net profit to get the trading profit. Only trading profit we can use for goodwill. Then why it is maintainable? Because whatever profit we have earned over the years, if we get the average of them, it is not necessarily sustainable in the same form. In the next year, there may be certain increase or decrease in the expenditure. There may be certain revaluation items. There may be certain write-off of current assets, etc. So what we need to do, not whatever profit we have earned on an average over the year, but what we are going to sustain, what we are going to maintain. So if there is any future expenses, that is also to be deducted. Okay. Future income may be added in that way. So how to calculate this average profit, or what we call the average maintainable trading profit? Now, first of all, we need to get the simple or weighted average profit of past years. Now, whether we will be using simple average or weighted average, again, it depends on so many factors, and in most of the cases, there may be certain assumptions used. Now, at this respect, or with respect to this chapter, valuation of goodwill, there are possibilities of different assumptions leading to different type of answers. Provided your assumptions are realistic, your answer is correct. Okay, so far your assumptions are realistic, your answer is correct. In that way, when we calculate the average profit, we can take simple average or weighted average. When to take simple or when to take weighted average? When the profit is fluctuating, you take simple average. When the profit is fluctuating, you take simple average. But when you find that profit is either having a particular trend, equal increase, equal decrease over the time, then, or equal percentage increase or decrease over the time, then you consider that trend and accordingly use the weighted average. Now, while using the weighted average, use the weights that have been given in the problem. If only not given, you may assume weight 1, 2, 3 for earliest year, near and nearest, and 3 for the nearest year, 1 for the earliest year and 3 for the nearest year. However, keep in mind that if in the examination, if that weighted average profit is to be calculated, this is not mentioned. Be careful. If the profit is fluctuating, always use simple average. If the profit is declining or increasing, but by different amount, but by different percentages, again use simple average, only use weighted average when it is given in the problem or when there is a particular trend, similar trend observable. Otherwise, use simple average. No, that is average annual profit. With this average annual profit or from this average annual profit, we need to arrive at maintainable trading profits. So for that, we need to add back all non-trading expenses. What can be the non-trading expenses charged to PL? There may be interest on loan, interest on debenture, any loss on sale of assets. Those are to be added back. Similarly, all non-trading income should be deducted. What can be the income? Income on non-trading investment, profit on sale of asset, those are to be deducted. Now, in order to ensure that maintainability, if there is any exceptional or casual income which has been earned during the current year and not likely to maintain in the next year, you should exclude that casual income. And similarly, if there is any abnormal or non-recurring kind of a loss which is not likely to arise again in future, you should add back that loss also. So these two adjustments are for that maintainability factor. And similarly, if there is any change in the value of the fixed assets and depreciation further to be changed, add less depreciation adjustment should be there. That is also for maintainability. And finally, if there is any increase in expenses, say directors' fees are increasing, so you need to deduct further for future increase in the expenses. So this non-trading expenses and income to convert the net profit into or average net profit into trading profit, and this exceptional casual income, abnormal non-recurring loss, and adjustment for depreciation or adjustment for future expenses. These are for that maintainability of profits. Okay, so that will give us the average future maintainable trading profit. Now, if there is tax given and the profits are before tax, do all the adjustment with full figure and at the end deduct the tax. And if all the profits have been given from the very beginning at net profit after tax, then do all the adjustment as after tax. That is, with the figure of the particular adjustment, you multiply 1 minus T. T stands for tax rate. Now, when you have already calculated this average maintainable trading profit, preferably after tax, next is the requirement to calculate the goodwill. Now, there are two methods available under average profits for calculating goodwill, and I will suggest the second one, not the first one, but still the first method assumes that assumes that the value of goodwill will be the average maintainable trading profit multiplied by the number of years purchased. That is, here it is assumed that the profit the company is earning, it is entirely due to its superior earning capability, and the number of years it will be able to sustain that profitability, that will give us the value of the goodwill. So accordingly, average maintainable trading profit after tax into number of years purchased will give us the value of goodwill. On the other hand, under capitalization method of average profit, value of goodwill is determined as the difference between capitalized value of average profit and trading capital employed. Now, the capitalized value of trading profit is nothing but average maintainable trading profit divided by the normal rate of return. So average maintainable trading profit after tax divided by the normal rate of return, obviously after tax, minus the trading capital employed will give us the value of the goodwill. What is trading capital employed? We will come to that later on. Then super profit method. Now, this is a better or more desirable method as compared to the average profit method for calculating the goodwill. Under super profit method, super profit is calculated as the excess of average future maintainable trading profit that we have determined just before, over and above the normal return on average capital employed. So we need to know these other few terms: normal return on average, normal rate of return, average trading capital employed, etc. Let us take up this issue one by one. Now, while calculating the goodwill under super profit method, the very first thing that we need to know is the average future maintainable trading profit, preferably after tax. For that, the same methodology we will apply as has been described under this average profit method. So there is no change with respect to that calculation. average maintainable future trading profit. Whatever method we have applied so far, that will be similar applicable here also. But we need to know the average trading capital employed. What is average trading capital employed? Now, for that, first we need to calculate the closing trading capital employed. What is closing trading capital employed? The term trading should be given more emphasis here. Now, while calculating capital employed, what do we do? Capital employed we calculate by taking the value of assets, and from which we need to deduct the current liability. That gives us the capital employed. That is, capital employed refers to own capital plus debt capital. Okay. So if we are going from the asset side, then closing capital employed will be all assets at fair value minus current liabilities and provision at fair value. If there is any contingent liability, that is also to be considered here under current liabilities category. Now, since we need to calculate not closing capital employed, but trading capital employed, then we need to exclude certain non-trading assets. Always fictitious assets who are not generating any return are excluded from capital employed. And if in the problem, already a goodwill value is being shown in the balance sheet of the company for which we are going to value the goodwill, that goodwill represents the purchase goodwill, because self-generated goodwill can never be recorded. So whatever goodwill is appearing in the balance sheet, it certainly means the purchase goodwill. Now, since we are going to calculate the goodwill now, this purchase goodwill and self-generated goodwill, they will merge together. So we won't consider this purchase goodwill to be an asset already. Rather, we will consider the final goodwill to be having the impact of both own goodwill plus purchase goodwill. So the method is simply take all the assets, including the cost of purchase goodwill, but excluding non-trading assets and excluding fictitious assets at fair value. From this, you deduct current liabilities and provision. Also include contingent liability, if any. That will give you the closing trading capital employed. Now, from this closing trading capital employed, we need to arrive at average trading capital employed. Why it is so? Because profit is earned during the year. So if from the profit, average maintainable trading profit after tax, we need to deduct certain basic profit, minimum profit, that profit should also be having a concept of during the year and not at any point at the end of the year. Suppose the opening trading capital employed was 5 lakh, but at the end of the year, there is capital employed only 1 lakh. So if we consider that 1 lakh closing trading capital employed, then normal return will be very less and higher amount of super earning capacity will be reflected, which is wrong. Because during the entire year, suppose the company was running with a capital of 4 lakh and on the last day only the capital has gone down to 1 lakh. So don't take the closing trading capital employed, we need to take the average trading capital employed. So how to get that? Closing trading capital employed minus half of the current year's trading profit after tax we need to deduct. Keep in mind, it is not future maintainable trading profit, average trading profit we are not deducting. We need to deduct only current year's trading profit after tax. Okay, if current year's profit is not given, closing trading capital will be the final one. There is no possibility of calculating average trading capital employed. Okay. So closing trading capital employed minus half of the current year's trading profit after tax will give you the average trading capital employed. This is the capital that has been employed during the year. So on this, we should have earned the normal rate of return. So now calculation of the super profit, which is average future maintainable trading profit, preferably after tax, less normal return on average trading capital employed. That is average trading capital employed multiplied by normal rate of return, which will be given in the problem. That will give you, the difference will give you the super profit. Normal rate of return, which is normally given in the problem, it is actually the combination of two parts. One is the risk-free rate, and there is the premium for the business risk. That is for assuming the risk of the business, how much additional return I should get over and above the risk-free rate of return, which is available through different government securities. So together they give us the normal rate of return. With that normal rate of return, if we multiply the average trading capital employed, we will get the normal return on average trading capital employed. And the difference between average maintainable trading profit and normal return on average trading capital employed is the super earning capacity of the company. Now, if the super earning capacity of the company is sustainable, it will give us the value of goodwill. So there are certain methods such as number of year purchase method, which says that goodwill equal to super profit into number of year purchase. Capitalization of super profit method, which says that it is super profit divided by the normal rate of return. And annuity method that gives us super profit into annuity factor. Annuity factor is nothing but the present value of rupee 1 invested on a regular yearly basis up to a certain period of time, if discounted at a certain cost of capital or certain discounting factor. That gives us the annuity factor. So now, with this concept of goodwill, let us take certain example, and then again we will come to our next assignment, that is valuation of share. Okay, let me just go for this second note on valuation on goodwill. There are certain examples already I have considered. Now, the very first illustration that we need to consider, just let me zoom in a bit. Okay. Illustration 1, it is on valuation of goodwill under super profit method, a simple problem. Suppose capital employed of Venus Limited was 20 lakh and trading profit for the last 3 years ended on 31st March 20, March of the year were 2 lakh 90, 3 lakh and 3 lakh 10 respectively. Normal rate of return is 12% and super profit is expected to be maintained for the next 4 years. Determine the value of goodwill. Consider closing trading capital employed, specifically mentioned. First of all, in order to calculate this super profit, we need to know the average future maintainable trading profit. We are given with 3 profits. There is no information regarding any non-trading investment income. There is no information regarding any interest on loan, interest on debenture, any loss on sale of asset or profit on sale of asset, etc., or any future expenses, etc. Any kind of abnormal profit which is non-recurring. There is no such information. So simply we are assuming that this trading profits that has been given over the 3 years, it is the maintainable trading profit. So get the average of the same. Now, what kind of average we can take? We can take simple average. We can take weighted average also. But what I follow, or what I will recommend to follow, is that whenever weighted average is profit is required to be calculated, this mentioned in that way, then only use this weighted average, otherwise not. Okay, so here there is no such mention. So we are taking simple average. 2 lakh 90 plus 3 lakh plus 3 lakh 10 divided by 3 gives us 3 lakh. From this you deduct normal return on average trading capital employed. Normally we take average, but here it is closing trading capital employed they have mentioned to be considered. So normal return at the rate 12% on closing trading capital employed of rupees 20 lakh given at the very beginning will be the normal return, 2 lakh 40. So the difference is 60,000. It is the super profit. Now they have said that this super profit is expected to be maintained for 4 years. So we need to consider this 4-year multiple. So value of goodwill will be super profit 60,000 into number of year for which super profit can be maintained. Here it is 4. So 60,000 into 4, 2,40,000 is the value of goodwill. Okay, it is a very simple problem. Now let us take another example which is relatively complicated, relatively higher grade. Valuation of goodwill under super profit method, a comprehensive problem. Now from the following information, we need to determine closing trading capital employed, and here in this case average trading capital employed, and finally value of goodwill under super profit method on the basis of 5 years purchase of average super profit. Okay. So we are given with a summarized balance sheet of Z Limited. Since it is summarized balance sheet, the format was not required and we followed our old format. Otherwise, in the examination, if they provide a balance sheet under Ind AS format, so accordingly division 2 schedule 3 format of balance sheet will be followed. So what do we get on the asset side? There are some property, plant and equipment 3,50,000. These values are book value. And investment 6% government loan 45,000, current assets 2 lakh. On the liability side, we get 2 lakh equity share capital in form of 20,000 equity share, 9% preference shares of 1 lakh, number of shares are 1,000, other equity 1,25,000. Other equity actually represents reserves and various other heads. If nothing is mentioned, we can assume that they represent reserve. 10% debenture is there, creditor is there, provision for taxation is also there. Now, the current market value of the plant included in PP is 15,000 more. So whatever PPE value we are seeing, that is 3,50,000, it is the book value with which there is some addition, increase in the market value of one plant, 15,000 to be added. So it will be 3,65,000. Individually, the PPE. The average profit of the company after deduction of interest and government tax is 68,000. So we need to convert them into future maintainable trading profit after tax. Trading profit after tax earned during the year, that is during the current year only, 70,000. Normal rate of return is 12% and depreciation rate on plant is 10%. Tax rate 40%. Okay. So first of all, we need to calculate the closing trading capital employed. So what is closing trading capital employed? Obviously, capital employed means total assets minus current liabilities. So in that way, if we take the total assets of the given balance sheet, that is 5,95,000. With this, we need to make the adjustment for fair value changes. However, out of this total asset, obviously, we need to exclude non-trading investment. Here you can see the investment has been given in the form of 6% government loan. That is, it is not an investment within the business. So it is a non-trading investment. So we are deducting 45,000 non-trading investment because we need assets which are only trading assets. Now with this, we are adding increase in the value of plant because the value of plant has increased by 15,000. So 15,000 has been added. From this, we are deducting the current liabilities, which are provision for tax 20,000 and creditors 60,000. So that gives us a closing trading capital employed 4,85,000. Now from this, we need to